Yeah. Hello, students. Today I will explain marginal costing and differential cost analysis. So this chapter covers in black 4, unit 8 and 9. Yeah. So in this chapter, I'm going to cover definition of marginal costing and differential costing, importance in marginal decision making, and overview presentation. What is the meaning of marginal cost? So marginal costing means what? Marginal costing is the additional cost incurred for the increasing of one additional unit of output. Marginal costing is a nothing but the variable cost. So simply I can explain from this definition, marginal cost, it is a additional cost. Whatever the increasing of output and it causes to increasing of total cost. So that is called as a marginal costing. So marginal costing are also called as a variable costing and step costing. So marginal cost as the amount of at any given volume of output by which is aggregate cost are changed if the volume of output is increased. So simply I can say that when the output is changed, the cost also going to be changed. So if the cost increase, if the output increase, total cost also increase. If the cost decrease, total output also decrease. So that is the marginal costing. So marginal costing is the method of ascertaining the marginal cost, and it evaluates the effect of fixed and variable cost on profit due to change in the volume of production. So fixed cost generally it is treated as a periodic cost and not included in the product cost. Key features of marginal costing. It is separate fixed and variable cost. Only variable cost considered for the cost per unit, and it helps the break-even analysis and profit planning also. And here we are going to use the contribution. The contribution is nothing but a selling price minus variable cost. What is the advantages of marginal costing? So marginal costing will help to take the decision and effective tool of profit planning, and it facilitates control over the variable cost. It provides the management with the many useful techniques for the decisions making like break-even analysis. So these are the advantages. And what is the limitation of marginal costing? Marginal costing assumes that semi-variable costs are segregated. It is excluded fixed cost decision making. It fails to reflect the impact of increased fixed cost due to development of technology and production cost. Variable cost techniques cannot be successfully applied in the cost plus contracts. Importance of marginal costing. Marginal and differential costing is helpful for the managers and profit planning purpose to determine the pricing and cost structure for the break-even point. It will helpful and product mix decision, maximizing contribution per unit under production constraints, and make or buy decisions, choosing between in a house production and outsourcing, shut down a product or plant. So whether the discontinue or loss making product, and selection of production methods. So these all are the very important in the marginal costing. So in marginal costing, one more factor, one more variable is we need to discuss, that is cost value profit analysis. So cost value profit analysis. To examine the relationship of cost and profits of volume of production, maximize profit of the firm. The method studying the relationship between cost, volume, production, sales, and their impact on profit is called as a cost volume profit analysis. What is the objective of cost volume analysis? So forecast the profit fairly and accurately. First main objective is forecast the profit fairly and accurately, and it acts as an effective tool of profit planning, and it helps in ascertaining the break-even point, setting a flexible budget. What is the elements of cost volume profit analysis? So marginal costing equation we are going to take, contribution we are going to take, profit volume ratio we are going to take. It is nothing but a PV ratio, and break-even analysis we are going to take, and margin of safety we are going to take. So let us discuss this order wise. Marginal costing. Marginal costing means what? So it is exhibit the relationship between the contribution, fixed cost, and profit. So marginal costing equation, it is set of variables, that is variable cost, fixed cost, profit, and sales. So this is marginal costing equation. Contribution is difference between, what is the meaning of contribution? So contribution is a difference between sales and variable cost. So it contributes towards fixed expenses and profits. So contribution is also known as a gross margin. So to calculation of contribution, we are going to use these methods, that is contribution is equal to selling price minus marginal cost, and contribution is equal to fixed cost plus profit, and contribution minus fixed cost is equal to profit, or the using of marginal costing equation, that is sales minus variable cost is equal to fixed cost plus profit. So this based on situation, we are going to use these formulas, and we are going to calculate the contribution. For example, there is a small problem, that is, from the following information, find out the amount of profit earned during the year using the marginal costing technique. So given data, fixed cost they given, variable cost they given, variable cost per unit they given, selling price they given, that is also per unit price they given, output level also they given, that is 1,50,000 they given. So here output level is equal to how much? 1,50,000 units. Selling price how much? 15 rupees per unit. So total sales we have to calculate. That's total sales is equal to nothing but a number of units output 1,50,000 into 15 rupees per unit, that is 22,50,000 is the total sale cost. And similarly, variable cost per unit also we have to calculate. Variable cost, again this 1,50,000 into 10 rupees, that is 15 lakhs. So minus 15 lakhs you can deduct. So total 7,50,000 is the contribution. Simply output level I taken 1,50,000 and I multiplied the selling price, that is 22,50,000, say total sales, minus variable cost, the cost per unit they have given, per number of units I taken total variable cost, I deducted from sales to variable cost, I will get that. This is the method. So here sales and marginal cost 7,50,000 is the contribution. Profit calculation. So contribution total is equal to 7,50,000. Out of 7,50,000, fixed cost is the contribution. With the help of contribution equation, we can calculate the profit also. So contribution is equal to fixed cost plus profit. Already we know the contribution, we know the fixed cost. So contribution is equal to 7,50,000. Fixed cost also they given in the problem, that is 5 lakhs. So this contribution 7,50,000 minus 5 lakhs is equal to profit. That profit is equal to contribution minus fixed cost. 7,50,000 minus 5 lakhs. So remaining 2,50,000 is called as a, that is profit. And next one is the contribution is over. Next one is the profit volume ratio. Profit volume ratio is one of the most important ratio for studying the profitability of operations of a business or established relationship between the contribution and sales. So the formula for using of competition PV ratio, contribution divided by sales. So shortcutly I wrote here contribution minus divided by sales. Or you can use, instead of contribution, you can use fixed cost plus profit divided by sales. So short form I wrote here. And that contribution is nothing but a sales minus variable cost divided by sales. So you can use, sometimes 2 years data they will give. So for that 2 years data, change in profit by change in sales, that is, if they given 2 years data, the difference of 2 years period profit, the difference of 2 years data sales, I taken here. Next one is the, otherwise, sometimes they will give the contribution also. Change in contribution by change in sales also we are going to use. With the help with the help of these formulas, we can calculate that, that is PV ratio, profit volume ratio. Next is the break-even point. What is the meaning of break-even point? Break-even point is the level of activity, the level of sales, the volume at which there is no neither profit or loss. So it is at this point, the fixed cost is equal to the contribution. The level of activity at which there is neither profit or neither loss. Break-even point and profit calculation. See here, break-even point and profit calculation, BEP is equal to fixed cost divided by profit volume ratio. Fixed cost, if you want to calculate fixed cost, break-even point into PV ratio. So sales required to earn the maintain with the break-even point, these all we are able to calculate. That is, so break-even point, fixed cost, this break-even point we are going to use to calculation of break-even point and fixed cost and profit sales, contribution, variable cost. These are all the situations we are going to use. So there is some question. The following data is given: fixed cost expenses, that is 1 lakh rupees, variable expenses rupees 10,000, 10 rupees per unit, and selling price is equal to 15 rupees per unit. Indicate the number of units manufactured and sold in the sold. So here to break, we have to calculate to break even and to earn the profit 10,000. So first we have to calculate the break even point. Here total how many units they are producing? Selling price is there 15 per thousand, 15 rupees per unit. And variable expenses is there, that is 10 rupees per unit. So here break even point we have to calculate. And also second question is what? To earn the profit of 10,000, what is that? So break even, contribution is equal to selling price is equal to how much? Here 15 rupees is the selling price and variable cost is equal to 10 rupees. So the contribution cost is equal to 5 rupees per unit. So break even point total fixed cost divided by contribution. So contribution per unit, sorry, here I need to mention contribution per unit. So total fixed cost is equal to 1 lakh. So 1 lakh divided by 5, total 20,000 units are required. When you sold the 20,000 rupees, you will recover the fixed cost only. So 20,000 rupees we required. And sales to earn the profit of rupees 10. So how much is the break-even point? So fixed cost is equal to how much? 1 lakh. And desired profit how much? 10,000. What is the contribution per unit? So total 5 rupees is the contribution per unit. Total 1,10,000 divided by 5 rupees per contribution per unit. So 22,000 is the 22,000 units we need to sell. If you sell 22,000, you will earn 10,000 rupees of profit. Next. So margin of safety. What is the meaning of margin of safety? So margin of safety is that sales or output which is above break-even point. So after break-even point, whatever the sales is there, that all the sales we treated as a margin of safety. It is that the sales which is give us profit after meeting the fixed cost. So from the following details, find out the PV ratio, profit volume ratio, break-even point, margin of safety. Here, sales is equal to 1 lakh, variable cost is equal to 60,000, fixed cost is equal to 20,000. So I'll explain that. So sales, first we have to calculate profit volume ratio. To calculate that profit volume ratio, we required contribution. To calculate of contribution, we required sales and variable cost. So sales minus 60,000, 1 lakh minus 60,000, 40,000 is there. That 40,000 is our contribution. Contribution by sales is equal to nothing but a PV ratio. So 40% is the PV ratio and break-even point. So next to calculation of break-even point, what is our formula? Fixed cost divided by PV ratio. So total 20,000 fixed cost is there, 0.4. So almost 40%. 40% equal to 20,000. Then we required 50,000 is the break-even point. Margin of safety, sales minus break-even point. So 1 lakh minus 50,000, that is margin of safety. I'll show the answer also. Answer not given. Yeah. Simply just we can follow. First case, first one is what? Profit volume ratio. Profit volume ratio, how we are going to take? Profit volume ratio, how it is take? Simply contribution by sales. So contribution, how we are going to take? Hello? Contribution, how we are going to take here? I mentioned sales minus variable cost. That is 1 lakh minus variable cost 60 lakhs. So total is equal to, that is 40,000, 40K. That is contribution. Okay. Now after contribution, PV ratio is equal to what? PV ratio is equal to PV ratio is equal to contribution, this one. Sales into 100. That is 40,000 divided by 100K. Okay, total 40% is the 40% is the PB ratio. So after second one is what? This one, break-even point. That is formula is what? Fixed cost divided by PV ratio. PV ratio means what? Which is previously calculated. That is fixed cost is equal to 20,000. PV ratio is equal to 40%, 0.40. That is equal to the 50K, 50,000. 50,000. Next one is the margin of safety. Simple, this break even, second answer, whatever is there, break even point, actual sales minus break even sales. So actual sales, how much? 1 lakh. So that is 1 lakh 100K, 1 lakh minus 50K. So is equal to 50,000 is the margin of safety. Like this, we have to calculate that. Okay. So this is the formula. Yeah. What is the differential costing not required? This is the next chapter related information I will give you. So another PPT problems I will explain. So these are the all are the problems. First problem. This is the with the help of that income statement under the marginal costing. Sales minus variable cost is equal to contribution and less fixed cost. That is operating fixed cost, operating expenses. After that, profit. This is EBIT. It is nothing but a profit. So generally, marginal costing equation we showing like this. So first, sales minus variable cost is equal to fixed cost plus profit. See here, formulas which we are going to use in the marginal costing, that is for the calculation of contribution, sales minus variable cost, fixed cost plus profit, and profit volume ratio for the calculation of profit volume, that is contribution by sales into 100 or change in profit of change in sales into 100 for calculation of break-even sales, fixed cost divided by PV ratio, break-even sales in the units, fixed cost by contribution per unit for the calculation of margin of safety, actual sales minus break-even sales, or profit divided by PV ratio, and required sales to earn required sales, calculation of required sales, fixed cost plus profit divided by contribution per unit, and required sales to in units, fixed cost plus profit by PV ratio. So these formulas we are going to use. Go through these formulas. A company sells a product 50 rupees per unit. The variable cost per unit is 30 rupees, and company sells 10,000 units. Fixed cost amount is 1 lakh. Calculate the contribution and profit. So first contribution we have to calculate. Contribution, how we are going to calculate? Selling price they given and variable cost also they given. 50 rupees and 20 rupees. So that is 20 rupees is the contribution. This is per unit. If the company sells 10,000 units, 20 into 10,000, you will get the total contribution amount. The total contribution is equal to 10,000 units into 20 rupees. That is 2 lakhs. The profit is equal to total contribution minus fixed cost. Total contribution is nothing but a 2 lakhs, which is calculated before, and minus that fixed cost is equal to how much? They already given 1 lakh. So 2 lakhs minus 1 lakh, 1,000. 1 lakh is the profit. Next. So this problem relating to the break-even calculation. A farm has fixed cost 1,50,000. The selling price per unit is equal to 40,000 and variable cost per unit is equal to 25 rupees. Find the break-even sales. So here to calculation of break-even sales, first we have to calculate contribution. So contribution per unit is equal to how much? Selling price minus variable cost 40 rupees and 25 rupees, that is 15 rupees. Here break even, this is the contribution per unit cost. So next break even units we have to calculate. The fixed cost is equal to 1,50,000. Here contribution per unit is equal to 15 rupees. Total 10,000 units. So if the company sell 10,000 rupees, they will earn only 1,50,000 rupees. Next, margin of safety. So margin of safety problem, if the company has actual sales are rupees 6 lakhs, break even sales are 4 lakhs. So actual sales they given, break even sales they given. So direct we can calculate the difference amount of actual sales and break even sales is marginal cost. So 6 lakhs minus 4 lakhs, remaining 2 lakhs is the margin of safety. So margin of safety percentage also sometimes they are going to ask in the examination. To calculation of margin of safety percentage, simple margin of safety divided by actual sales into 100. So this margin of sales, whatever sales is there, what is the proportionate in the total sales? So that is 33%. Next. Yeah, some of the model problems also here. X Limited made sales during the certain period, that is 1 lakh. The net profit of the same period was 10,000. Fixed cost, fixed overheads are 15,000. Find out the PV ratio. So total, what is the sales? 1 lakh. Net profit is the net profit for the year same period is 10,000. So it is 1 lakh is the total sales. Profit is equal to 10,000 and fixed cost is equal to 50,000. Find out PV ratio. To calculation of PV ratio, what we required? Contribution by sales. Contribution, how you will get? We already know that fixed cost is they given and profit they given. So sales also they given. Remaining third variable is what? Variable cost. We don't know that. So 1 lakh minus fixed cost and profit. If you deduct this 25,000, remaining 75,000 is the variable cost. So that is the variable cost. Here direct PV ratio to calculation, you can take 10,000 plus 15,000. 25,000 is the contribution. Fixed cost plus profit. So 25,000 divided by sales, 25% is the PV ratio. Required sales to earn the profit of 15,000. To earning of 15,000, what is the sales we have to maintain? So for that, Here fixed overheads they given, we required profit is equal to this one. So 15,000 plus 15,000 divided by PV ratio. So total 15,000 plus 15,000, 30,000, 25% is the 25% is the PV ratio. Then what is that? 25% is equal to 30,000, then 4 times. So 1,20,000 is required. So if you sell 1,20,000, if you sell 1,20,000, you will get the 15,000 of profit. So net profit from sales is equal to 1,50,000. Net from what is the net profit? If the sales are 1,50,000. So 1,50,000 sales, when there is a sales 1,50,000, what is the profit? For here 1,10,000 profit, and when there is a 15,000 means what? 1,20,000. So it means what? Every 20,000 there is a 5,000 of profit is there. So net profit sales. So here 25% you can calculate direct. So that is 25% means what? 25,000 and 12,000. 37,500 is the 37,500 is the profit you will get when the sales are 1,50,000. How it is? So simply I'm going to show some formulas. So here first one is the PV ratio. So 15,000 and 10,000, that is the 25% as per explained. And next one is the PV ratio for sales. So here 15,000, 10,000 is equal to the required sales, that is fixed cost is the 15,000. The profit required 15,000. Sales are 1,20,000 we require. So here I taken the PV ratio 25%. So 1,20,000 is the sales. When the sales are 1,50,000, what is that? So I already explained 37,500. How it is? See here, 1,50,000. 1,50,000 is the profit, and profit we don't know. Fixed cost and this one. So 1,50,000 into 0.25, 25%. So that is nothing but a 37,500. So this is the criteria to calculate. So sometimes they will give the 2 years of data. From that also we have to calculate the following requirements. So they given particulars, they given years details, and they given year details. In sales 2022, in 2020, that is 2 lakhs, and in sales 2021, 2,50,000. Profit is equal to 30,000, and 21 is the 50,000. So first we have to calculate. That is PV ratio. To calculation of PV ratio, what we require? The change of profit divided by change of sales. So change of profit, how it is going to calculate? 30,000 difference. What is the difference? 50,000 minus 30,000, 20,000. And 2,50,000 minus 2,50,000. So 20,000 divided by 50,000, that is 40% is the PV ratio. So after once we calculated PV ratio, then you have to calculate break-even point. So break-even point, how we are going to calculate? Fixed cost divided by PV ratio. We know only fixed cost. We know only break-even point, but we don't know fixed cost. So we don't know variable cost also. They out of 4 variables, they given only 2 variables. So from here we have to calculate. For example, in the PV ratio, that is what is the percentage? 20,000 divided by change of 50,000. So 40% is the PV, 40% is the contribution. So 40% for any, you can take any 1 year. 40% is equal to how much? Out of 2,80,000. From 80,000, you can deduct out of these 2 lakhs, 40% of the contribution is equal to 80,000. So from 80,000, you can deduct this profit 30,000. Remaining 50,000 is the fixed cost. So fixed cost doesn't change for year to year. This is same for the every year. So that here also fixed cost is the 50,000. For example, if you take for this 2021 also, 2,50,000, what is the 40%? What is the 40% of 2,20,000? That is 2,50,000 divided by 40%. That is amount 1 lakh. Out of 1 lakh, 50,000 you can deduct. So 50,000 is profit, remaining 50,000 is fixed cost. So if you observe here also 50,000 for fixed cost, Here also fixed thousand is fixed cost. Now break even point you can calculate 50,000 divided by PV ratio. So 50,000 divided by PV ratio means what? 50,000 divided by PV ratio 40%. That is 1,25,000 is the break even sales for the year of 2,20,000 2020. So every minimum break even sales 1,25,000. Next one is the total variable cost for the 2020 and 21. See here already sales we know profit is equal to 30,000 and fixed cost is equal to 50,000. For the year 2020, 1 lakh, these 30,000 and 50,000, total 80,000 contribution you can deduct from the these 2 lakhs. So remaining 1,20,000 is the variable cost for the year of 2020. And 2021, 50,000 is the profit, 50,000 is the calculated fixed cost. Total 1 lakh. So variable cost is equal to how much? Out of 2,50,000, you can deduct this 1 lakh. So remaining 1,50,000 is the variable cost. Next, the sales earn a profit of 60,000. So you can 50,000 plus 60,000, 62,000. 50,000 is the our fixed cost, that is constant, and to end the profit how much? That is 60,000 rupees divided by 1,10,000 divided by 0.40%. So if you want to earn 60,000 rupees, you required your sales should be 2,75,000. 2,70,000. What is the profit or sales? If the what is the profit when sales are 1 lakh? So here 1 lakh is the sales, that is, and 40% is the contribution. So total 40,000 and our fixed cost is equal to 50,000. So here no profit, you will get the loss only. So minus 10,000, if you sell 1 lakh, you will get the minus 10,000 is the loss. Margin of safety when profit is equal to 80,000. What is the margin of safety? Simple for the calculation of margin of safety, 80,000 divided by 0.40. So 2 lakhs. So margin of say profit when the 2 lakhs is margin of 2 lakhs we need to maintain. If the profit is 80,000, the margin of safety is 2 lakhs. So I will show that same in the solution mode also. So PV ratio change in profit by change in sales, that is 40%, 50,000 and 30,000 I taken, and here 2,50,000 and 2 lakhs taken. So 20,000 and 50,000 40%. And next one is the PV ratio for the 2000 in the year of 2000, sorry, years some little 2020 and 2021 you can take. That is fixed cost is equal to, we don't know, 50,000 is the for the year of 2021. In the year of 2021, 50,000 is the profit they already given. So fixed cost we don't know. Total sales also we know that. So total 50,000 is the fixed cost according to this equation. The break even sales 50,000 divided by fixed PV ratio, that is 40%. Actually, this one is the 40%. 0.4. No. That is 1,25,000. So this is also remaining for the variable calculation. Already I explained. Same thing only. See here, the required sales 2,75,000. I explained, and minus 10,000 is the loss. When the sales are 1 lakh, there is a loss 1 lakh. So that is also I explained. Margin of safety when sales are 80,000, when the profit is 80,000, margin of safety should be 2 lakhs. I already explained that. So this is also same problem for the previous one. You can go through once. So this is the marginal costing equation problems and theory. Next class, we are going to discuss about the next method.